Welcome to PhillipCapital's Weekly Market Watch. The Singapore government released the Singapore budget on the 22nd February 2010. The Singapore budget is an explanatory budget that builds on Singapore Budget 2009 and includes tax measures that serve to enhance Singapore's position as an attractive investment destination. Today, we have Mr. Donnie Liu, CFD dealer from Phillip Securities, to tell us more. So Donnie, what is the key highlight for Singapore Budget 2010?
Okay, the key highlight is that the government will set aside 5.5 billion over the next 5 years to increase initiatives to rise productivities. This will be in the form of tax benefits, grants and training subsidies to help to boost enterprise and worker skills and expertise. This gives support to Singapore companies to grow more competitively in the global environment.
Any positive factor for the market?
There are some positive factors like the introductions of a new merger and acquisition allowance to encourage enterprise growth. For angel investors, a new incentive will allow eligible individuals to enjoy tax deductions at 50% of his investment at the end of his second year of holding of the investment capped at 500k, with a requirement minimum investment of 100k. There is also the extension of an enhancement to listed REITs concessions. The existing income tax, stamp duties and GST concessions for listed REITs will be renewed till 31st March 2015. I believe the extension of the tax concession will serve to maintain foreign institutional investor interests.
With the new implementation of the progressive property tax rule, will there be any impact on the property market?
Okay, the property tax had shifted from flat tax rate system to a progressive tax rate system based on the annual values of the properties. With effect from January 2011, a three-tier tax rate were applied for owners-occupied residential properties. A tax rate of 0% for the first $6,000, 4% for the next $59,000, and 6% for the balance of annual values in the excess of $65,000. For non-owner occupants residential properties and other properties, these will continue to be subjected to a flat 10% property tax. Under the progressive property tax rule, all HDB flat owners and most of the private property owners will pay lower taxes due to the tax savings of $240 from the exemptions of the first $6,000 of the annual values. Owners of high-end properties with annual values of more than $77,000 will see a small increase in tax payable as their effective tax rates will be higher than the current 4%. On the whole, I do not expect there will be any major impact on the property market, even though owners of high-end properties will have to pay higher property tax. This group of people is about 0.4% of all owner-occupied homes in Singapore. The increase in property tax will not have a significant impact on their net wealth.
How do you feel about this Singapore budget package?
In view of all the measures, it is all about increasing productivity in the economy by tax incentives to both companies and individuals, while providing additional protections to the lower and medium income groups. I believe this will make Singapore an internationally competitive tax regime. The continued tax breaks will attract foreign investment and help the economy to expand. As a whole, it will definitely improve Singapore economy.
Thank you, Donnie. That's all we have for you today. Tune in next week for more market updates.